May has officially begun, and that means it's time to come back with my top stocks for the month. I've done this for a few months straight now, and I'll put a link in the show notes to those videos over the last few months. But this month is going to be a little bit different. I only have 5 stocks on the list this month, and there are a few reasons for that. One, we're in the middle of earnings season. So a couple of these companies have already reported earnings. I thought results were really good. And I thought either the market's reaction wasn't appropriate or I'm seeing some sort of long-term potential that isn't really priced into the stock. So I'm seeing some sort of value. But I'm generally staying away from a fair number of companies who are going to report earnings over the next few weeks because I want to learn more about what's going on at the companies and what's going on with the economy. The other thing is we've seen some economic data over the last few weeks that are a little bit concerning. Economic growth in the first quarter wasn't necessarily as strong as you might have hoped. At the same time, inflation is remaining relatively high. Interest rates are staying relatively high. And as all of this is happening, that's generally negative for revenue growth and for profit growth for companies. But as all of this is happening, valuations for stocks are relatively high. So I don't want to be paying up for companies if the future is not particularly bright. So I want to be really strategic about what I'm buying right now, what I'm bullish on right now. I want to make sure I'm getting a value in a company that has a durable competitive advantage. So that's sort of the mindset that I have going into this month. Generally, the way I think about stocks long term, but with that backdrop, I'm maybe not willing to take the same kind of risks that I took a couple of months ago when valuations were a little bit better. So with all of that said, let's get to the 5 stocks. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's start with the first company that reported earnings recently. That is Alphabet, the parent company of Google. I'll show a couple of charts here. But what we're seeing in the core business, particularly search and all the products around search, that includes YouTube, it includes their network, is we're generally seeing a re-acceleration of revenue growth. There are a couple of reasons behind that. One is we're now past ATT. And when Apple introduced app tracking transparency, which is what they call it, they broke the tie between an advertisement and when some sort of action was made. So if you clicked a link on your iPhone and it was a Google link, they couldn't necessarily track that to actually making a purchase. It made advertising a little bit more difficult and reduced the monetization. So didn't kill the company's revenue, but it kind of stalled the growth that they may have had. And we've seen that over the last couple of quarters that started to reverse. We're now accelerating growth again. So this is becoming more of a growth company in the core business. But there are 2 other pieces of the business, and then I've covered recently on this channel that I think are really intriguing long term. The first is Google Cloud, grew 28% last quarter, is now starting to be profitable and consistently profitable. They were actually GPU constrained this last quarter, so they could have grown even faster. I think this is the kind of business that could grow in excess of 20 or 25% on a compound basis for the foreseeable future, for the next 5, maybe even 10 years. And if that's the case, this is going to be a phenomenally profitable business. We are just at the point where they're starting to be operating margin positive. They're still in single digits, but long term, this should be a business that's going to be 20 to 30% operating profit. So you have growth in the core business, upside in Google Cloud, and the moonshot here that I think is really interesting for Alphabet is Waymo. Waymo has arguably the best technology in autonomous driving. They're starting to scale in 4 cities in the US. And this is the kind of business that could eventually be a global transportation network. We have a lot of questions to answer about what the business model looks like. Are they going to build their own custom cars? Are they going to license out their technology to somebody else? But I think it's very clear that they have the right technology for autonomous driving. And now it's just a matter of scaling that business. So as far as I'm concerned, that is pure upside. And investors are getting a pretty good value when you consider all 3 of those businesses. As I'm recording, shares are trading for 25 times earnings on a trailing basis, on a forward basis, trading for 21 times earnings. So that's pretty good for a company that is expected to grow revenue at 12% over the next 2 years. And I think they can probably exceed that growth target. So Alphabet, much better positioned than I think a lot of the other tech companies when it comes to artificial intelligence, when it comes to monetizing advertising. And that's why this is one of my top stocks for May 2024. The second stock on the list is another one that's a little bit out of favor. That is MGM Resorts. The casino business has really become just a cash flow business. There's not a lot of places that you can increase supply. So if you look back over the 70s, 80s, 90s, it was all about building bigger and bigger casinos on the Las Vegas Strip. Well, we're just not doing that anymore. the Las Vegas Strip is pretty saturated, but people are still coming in huge numbers. And there are a lot of reasons for that. But one is, as more people work from home, people need to go meet in a central location to do meetings, to meet up with friends, to have conferences. And Las Vegas is a natural place to do that. The entire region has invested a ton in not only that convention infrastructure, but also events like Formula One race, like football games. So I think this is a really attractive space to be owning a business long term. On top of that, you have similar dynamics in Macau, where there's limited supplies based on what the government decides, not only from the number of casinos, but for the number of tables in each casino. So those are both really cash flow businesses. But the upside for MGM Resorts long term is the Japan casino, which is now starting construction and is going to be open probably in 2030. So that's long term upside. But in the meantime, we get a company that is trading for pretty reasonable valuations. On the last conference call, management estimated that if you pull out their value in Macau, which is a publicly traded company, they own about 56% of that subsidiary, and you pull out the value of BetMGM, which is 50% owned by MGM Resorts, the rest of the business is only trading for 4 or 5 times EBITDA. So what they're doing is they're aggressively buying back stock. And I think that's going to continue if the stock continues to flounder, which I'm happy to let them do at the current valuation because, like I said, there's not a lot of places they're going to be able to invest multiple billions of dollars to grow the business. So might as well just buy back stock, reduce debt, and continue to return that cash to shareholders because I think long-term, the cash flow story in the gambling business, whether you're talking about Las Vegas or Macau or the potential growth in online gaming, is a great story for MGM Resorts. So that's why I want to be buying more of this stock. They're going to report earnings actually after the market today, so we'll see how that goes. And I will be back to cover that on this channel later this week. But right now, I love the position of MGM Resorts, and I think if you take a long-term view, there's a great potential for this stock. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The third company on the list is General Motors. I know not the most popular name as investors try to look for growth in things like electric vehicles or autonomous driving, where that does exist. But if you think about General Motors, this is a company that is currently trading for about 4.5 times what management guided for earnings in 2024. That's an update in just the last couple of weeks. They actually increased their guidance for 2024. They're buying back stock at a really, really rapid rate. At the same time, they're investing in electric vehicles, introducing more models later this year. They have a ton of success in trucks and SUVs, bigger vehicles, and have had a lot of success on the other end of the market, very small vehicles like the Chevy Trax. So you can think about them kind of investing in the two sides of the market, either really, really big vehicles or very small, low cost vehicles. And that's where they're generating a lot of their cash flow. But they also have potential upside in a company called Cruise. That's the autonomous driving company. They're now back on the roads, and that is a business that I would expect to scale over the next 5 to 10 years. But that's pure upside because, like I said, shares of GM are trading for just 4.5 to 5 times earnings for 2024. That is just an incredible value, and I think shows that investors don't have a lot of belief that this company is going to be profitable long term. But that's exactly what it's been. And I think management has been much more prudent with the capital that they're investing, how they're returning money to shareholders, and the risk profile of the company. This is not the same risky company that it was in 2008, 2009. I think GM has arguably its best lineup of vehicles that it's had in decades. It's in the right markets in trucks and SUVs. If you live anywhere in the middle of the country, you know that those are extremely profitable and extremely popular. And so that's going to keep cash flowing through the system. And that's exactly what I want to get from General Motors is a cash flow business. Maybe not the sexiest business, but you're getting a phenomenal value. And like I said, I'm looking a little bit more at companies that can play offense by having a defensive position in the industry. And as we see electric vehicle sales fall, margins compress in that business, we're not seeing the same pressure in the core business for General Motors. So you get value at the core and you get upside from a business like Cruise. I love the potential for General Motors. By the way, outperformed a competitor like Tesla by a very wide margin so far in 2024, even after Tesla's recent bounce in the stock price. So don't be surprised if that continues. The fourth company on the list is Airbnb. Once again, a company that we will hear from soon as far as earnings go for the first quarter. But a couple of things that I think investors need to understand. We all know the core business of Airbnb, and that has been And that's been a very profitable business, a great cash flow business. But what you may not realize is there's nearly $20 billion in cash on the balance sheet. Part of some of that is Airbnb's cash itself, but some of that is guest money. When you spend money on Airbnb, you're paying for your stay up front, even if your stay isn't for a few months or a year. That cash sits on the balance sheet and it earns interest for Airbnb. That interest is then income for the company. By the end of this year, it's possible that Airbnb is earning $1 billion per year just on interest alone. So you have a great company with a great platform, a great balance sheet, and an ancillary revenue source from interest and the cash that's sitting on the balance sheet. So love the positioning there. But the other thing is I really like where Airbnb is sitting long-term with artificial intelligence. Brian Chesky, who is the founder and CEO of this company, talked on the last conference call about how they're going to be leaning into AI to become your travel concierge. And I think this is where Airbnb can really be a phenomenal growth company, is moving beyond just the business that it's been so far to the company that's booking all of your travel. If you could just talk to Airbnb, they could have information about what kind of places you like to stay, what sort of experiences you want to have, what your budget might be. And you can say, hey, I want to take a trip this summer with my family. I want to do some experiences and I want to go to this part of the country or have this kind of budget. And they could literally build that for you and plan out that entire trip. I think the potential to grow the business on the back of those kind of tools and artificial intelligence are just phenomenal, because AI isn't actually what they're selling. AI is just enabling the business to grow into more verticals and to add more value to customers. So that's just a phenomenal use case for artificial intelligence. And I think Airbnb is one of the companies that's uniquely positioned with a platform and two-sided markets where you have users who are going to be the inputs, they're going to be the demand, and then you also have the supply. So that supply can be rentals that they have today, but it could be experiences, it could be airplane travel, it could be train tickets, it could be Ubers. There's a ton of optionality for Airbnb long term. So I think you're getting a phenomenal core business. And once again, great growth potential that we haven't even seen for Airbnb to be your concierge when you travel. The final stock is Meta Platforms. This is not one that I own yet, but after the recent drop in the stock, I'm more intrigued than I've ever been by Meta Platforms, in large part because I love what they're investing in artificial intelligence. Mark Zuckerberg can use what's called a scorched earth strategy by using all of the capabilities and the GPUs that they have built around their core business, and then they can give away the Llama models. They recently open sourced the Llama 3 model, and by all indications, that's one of the best artificial intelligence models that's out there. That means that there's going to be very little value generated from companies just building models. So that's what I mean by scorching the earth. They're trying to commoditize their complements or the supply. But then what is Meta going to do with those models? Well, right now we're just in a testing phase, but they have opened up artificial intelligence on their apps. So you can talk to their apps the same way you would talk to something like ChatGPT. They also have a Meta AI website. But I think this is a company that can ultimately be providing a lot of different services. So it can make their core business better by making their advertising more effective. You can create generative ads, whether that's images or text or even audio. And in the future, I think this is the kind of tools that businesses will plug into and provide a lot of value by using the Meta Platforms platform of products, not just on their family of apps, but even across the web. So I think a lot of potential for growth there. The pullback in the stock has made shares much more attractive. I would actually like the stock to fall even further before buying in. I think there's the potential that will happen over the next few months and quarters as the company invests more and more in artificial intelligence. And the payback for that is probably not going to be seen for 2, 3, 4, 5 years. But Mark Zuckerberg has shown that he has the vision and the ability to execute on these kind of technology improvements. And there's only a handful of companies that are going to dominate AI at scale. I think Meta is going to be one of them. And they have a unique business model and a unique ability to monetize that other companies just don't. So those are the 5 stocks that I have today. Like I said, I'm looking at a little bit more safety. I want to have that upside optionality, but I also want to make sure that I'm getting a good price for stocks. So that's why that's a little bit smaller list than I've had in the past. That may continue to be the case depending on what we hear about economic data and earnings data over the next couple of weeks. But let me know what you think about those 5 stocks: Alphabet, MGM Resorts, GM, Airbnb, and Meta Platforms. Which one is your favorite? I'll leave your comments in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.